Crypto markets fail to participate in the risk asset rally as lenders get bailed out by stronger hands. Realized vol collapses into line with implieds, and Solana sees some large call buying. All this and more in this week's Crypto Insight. Crypto this week, what's going on in Bitcoin? I mean, we have seen a bounce, but if we compare it to the likes of equities, it's been pretty pathetic, right? So we had our flush out over that weekend. This was a much quieter weekend, obviously. But you kind of look at that price action and it's not overly inspiring, right? I mean, I've written uninspiring bounce. So that's literally all I could say to that. You know, I was looking at, levels up to the mid-20s, for us to really bounce to. And given how much equities are rallying, I would have thought we had a half a chance of getting there. So far, no such luck, right? So the crypto market's not really participating. You could probably put that down to the idea that there's a bit of overhang, right? You obviously had the likes of BlockFi and Voyager, these lenders getting bailed out recently. So there could have been another Celsius type debacle there had they not got credit lines and got bailed out. So that was worrying. Three Arrows Capital defaulted in the order of magnitude of $600 to $700 million to Voyager, right? So that would have left a pretty large hole. Okay. So thankfully we had Mr. Sam Friedman. I can't even remember his surname, of FTX. But he comes in as your modern day JP Morgan and bails out the crypto lenders, which is quite funny. So he's come in. From a technical perspective, that price action looks very corrective, right? It certainly doesn't look like we've bottomed by any stretch. Yeah. If that was a proper bottom, you would have liked to have seen a much more impulsive move off that. So from a wave perspective and a technical perspective, I mean, it clearly looks corrective, which means we have further downside to come. And that kind of fits in with our equity view that the sell-off's not done yet. That risk sentiment's still got lower to go. It might be that the violent part of the crypto move is done, and we've seen most of the really violent liquidations, and we kind of have a drip lower, and we get a more violent move in equities over the summer and a more of a drippy sort of move down in crypto. That is very possible, right? And that would line up with like some of the waves and say, if we've seen our third waves in crypto, maybe we're going to see fifth waves down, and the market kind of, does what it did in the last crypto winter and is in a consolidation lower, makes lower lows, but doesn't do it in as violent a fashion, right? So that's kind of the scenario I'm starting to warm up to seeing. And the start of that scenario happening is seeing decorrelation between equities and crypto, right? If crypto was rallying just as hard as equities, then you'd expect it to sell off just as hard as equities, right? The fact that it can't rally with stocks gives it half a chance of when stocks do roll over, maybe it doesn't sell off as hard as well. Remains to be seen, but we can only hope and pray, that is the kind of price action we start to see, and we start to see a decoupling and decorrelation between the two asset classes, right? Which up until now, we certainly haven't seen. So those are my thoughts on Bitcoin. If we look at, Ethereum, the chart's pretty much the same. I suppose you could have a look at the ETH Bitcoin cross. That has bounced quite nicely to this level at 0.059-ish. You kind of need to see that break to then maybe get another 10% charge in the spread. And then that's a huge level up there. But good to see a little bit of relative strength coming from Ethereum, outperforming by about 6% relative to Bitcoin this week. Bitcoin's actually worst performer, up 5%. You had ETH up 11%, Solana up 15%, and then some of the other alts flying, like Polygon or Matic, it's up 45%. I don't know the story there because I just don't look at the alts in as much detail. But there was a story out on Solana, which is that they're going to launch their own phone, basically, right? Saga phone or something, right? I think it's called. And they're basically trying to make Web3 mobile, basically, right? So that's, you know, I can sympathize with the idea, right? You know, that it makes sense if no one else has done it yet. I mean, apparently other people have tried and failed, you know, but they're trying to basically create a phone that can also act as a bit of a hardware wallet. So, you know, so you can secure your crypto off exchange and things like that. I think that would probably take off, right? If they managed to pull it off. But they're talking about potentially rolling out this phone and having it early next year. So, you know, you can see that could be something that, you know, Solana kind of often needs a bit of a narrative, right? It needs a bit of a bullish narrative. It needs something to get excited about, as do a lot of cryptos, right? Maybe this is the next thing for people to get excited about in Solana, right? And we're definitely seeing some option flows that kind of suggest people might be a bit excited about Solana, although I think they're probably too short dated, the options, but we'll talk about that when I talk about the flows in the vol section, basically, right? But it was a quick one from me in terms of the crypto. I'm going to hand over to Aaron. Let him do the glass node, and then I'll come back. Yeah.
This week for on-chain, we're going to go ahead and look at Glassnode. We'll get to my thoughts on Wolfman a little bit after this. But for this week, the basic kind of theme for Glassnode was, as you can see at the bottom of the screen here, will this time be different? You know, basically, they took the week to look at different macro models and indicators that have historically pointed to macro lows or floors or bottoms, whatever would you like to call it. And so the question is, now that we're getting in these areas, is this time going to be different? Is this going to be the bottom, or do we have more pain to experience this time around? So first thing first, in the top left, this bear market floor model, it basically takes 5 different widely used macro indicators and overlays them on top of each other. You have the Mayer multiple, which we spoke about maybe last week or the week before, which compares the current price to the 200-day moving average. And when you get below that 0.6, if you recall, it was an oscillator. When you get down to that 0.6 level, that's generally been kind of the bottom, where you have, you know, the trade basically means you're trading at a 40% discount. The next, you have the realized price. That's the price where the value where the coins were last moved on chain. You can see here, we've only traded below the realized price 14% of all the trading days that Bitcoin has been live. And actually, real quick, going back to that Mayer multiple of 0.6, we've only traded closed under that level 3.4% of the time. After the realized price, you have that 200-week moving average, which is historically highly followed in the Bitcoin area and has been a pretty good macro indicator. When we hit that kind of 200-week moving average, we have tend to bounce from there. We've only closed below that point 1% of all trading days. From there, we have the balance price. The balance price is an interesting one. I'm actually going to click over here. I had to actually look up what exactly balance price meant. And it's basically just the difference between the realized price, which is where, like I said, the last time the coins were moved on chain, the difference between that and the transfer price. So the transfer price defined by Glassnode is just the cumulative of all the coin day destruction. And so if you recall, coin day accumulation is when a coin hits an address or a wallet. From there, the days that those coins aren't moved, that just accumulates the coin day accumulation. And the second that coin moves out of that wallet, out of that address, that's coin day destruction. So you have that balance price is looking at the realized price minus the coin days that have been destroyed. And we have only traded below that, even less than the other ones. 3% of the time have we managed to get under the balance price. And lastly, you have the delta price, which is the difference between the realized price and the all-time average price. We've actually never closed before below the delta price, but we did in this recent capitulation down to 17,000 briefly get under there. So again, looking back at this chart in the top left, we've overlaid all those different macro indicators, and then these bright green lines you can see. Shout out to Options Insight. Glassnode obviously knew we were going to use this. It basically is overlaying the times where we have traded below the realized price, below 0.6 Mayer multiple, and below the 200-week moving average. As you can see, it has not happened very often. And in fact, only 13 days out of 4,000 roughly trading days, 0.2% of the time, have we ever been in this kind of circumstance. Moving on from there, in the top right, we have the reserve risk, which is basically just looking at realized price divided by all the coins being hodled, as Glassnode kind of dictates what coins that are getting hodled. And basically, you get this heavy movement when we get down here, when spec positions move out and you're really only left with the hodlers, the people who really believe. And as you can see, we really only get down to this level of hodlers remaining in deep capitulation moves, flash crash from 2020, end of the 2015 bear market. And that kind of plays right in line with this chart in the bottom left, that realized hodl ratio, which captures the value of the coins that are 1 to 2 years old and comparing them to the 1 week old coins. And you can see, over time, we basically have been trading in a narrow range. And when we get to these macro lows, it basically is just saying there are no spec positions left. There are no inexperienced investors left. It's all people who have strong belief. They're the hodlers. And historically, this has bottomed out right around where we're at. And then the inexperienced investors tend to step back in. The prices are more attractive. And then that kind of leads to more of a bull market. And then lastly, in the bottom right, we have the percent supply and profit. As you could probably decipher from the name of it, it's just the amount of coins that are still in profit from the last time they were purchased. And previously, this has bottomed out around 40 to 45%, basically meaning that more than half the coins get underwater before we bottom. That recent plunge we saw, not last weekend, but the weekend before, to around 17,000, actually took the market just below 50%. When we did get down there, there was a lot of coins shuffling, changing hands. And once all that dust settled, basically Glassnode said that if we were to take a move down to that 17,000 area again, that would indeed put us in that 40 to 45% range. So that could potentially be that bottom, that bear market floor, if this time is not different, but that remains to be seen. Now, before I sign off, a real quick note about Will Clement, his analysis. It was interesting. I thought we were finally going to be able to feature some of his stuff, as we didn't have a super action-packed weekend, like Imran had mentioned, but on-chain was not mentioned. Not even the word was mentioned in the entire newsletter. So I wasn't really sure what to take from that. He's like the leading on-chain guy. I don't know if that means maybe he's softening on the signal that on-chain could give, or if there just wasn't a lot out there. I just thought it was interesting that the on-chain guy generally isn't featuring any on-chain stuff. He did have one interesting note talking about Bitcoin miners. We spoke about a decent amount about Bitcoin miners last week, and the capitulation you typically see. It's pretty interesting. In May, you had Bitcoin miners sold over 4,000 coins into the market, and compared to the months before, April under 1,000, March just over 1,000, February 700, January just over 1,600. So pretty significant selling by miners in May, which, if you recall, you look for that miner capitulation. You get those weak miners out because they're pretty steady sellers, and then you're left with those strong holding miners, which tends to give a good bottom, a good base for price to start moving up. And then one final note, just in June alone, you have Bitfarms, which is one of those crypto exposed equities we've spoken about once before. They actually sold 3,000 Bitcoins just this month to raise $62 million for what they claim is to boost liquidity and take on a more conservative strategy. So you have the minor capitulation, you have these macro floors seeming to be hit. So like Glassnode was wondering, the question is, will this time be different, or do we still have more pain to endure before we can move on the way up? And that is on chain for this week.
In volatility analysis this week, in crypto vol analysis this week, realized vols collapsed, right? For those of you who got the crypto volatility dashboard on Friday, this is something I had flagged, right? In carry, we had a massive negative carry, literally like the most you can get or you've seen, right? Looking back 18 months or whatever. And it was very flattering, right? For like being long options, right? Because the odds were that realized vol, once the massive swings moved out the sample, that was going to collapse. And the implied vols were already pricing that, right? Because they collapsed into the DOV auctions on Friday. So we had this massive spread between implied and realized, which to the naked eye is, oh, gamma's an own massively. And it just really wasn't, right? And you've seen realized come massively down and basically right in line with where implieds were. Yeah. So this is what I say time and time again, right? Implied vol leads realized vol most of the time. Okay. So you gotta, it's forward looking, realized vol is backward looking. When things are more stable and you've not got extreme circumstances, then yes, maybe there's a bit of to and fro between them, right? But typically it's the implied vol that is leading the way. Yeah. And we certainly saw that this week in crypto. If we then move and look at the term structure, we see, again, something I'd mentioned, I suspected you know, the minute we got a bit of stabilization, we're going to try and go back into contango. And you can see the two curves kind of trying to get into contango with the front end collapsing and the back end holding. Now you've got this hump though, right? It's not a normal contango where it's just kind of upward sloping the whole way. You've definitely got a hump, and that hump seems to be forming at the end of July. Okay. So the reason we've got this kink or this hump in the term structure is because the market anticipates a bit more movement than normal in that time bucket. Okay. So, and the reason being is at the end of July, it captures the next inflation print, right? The next CPI. It captures the FOMC meeting in July, where we're expected to have another 75 bip rate hike. So these are things that the crypto market at least believes could create more volatility, right? So they're not really letting that end of July bucket collapse quite the same way that you would expect them to, basically, right? So that's why we get this thing. And also you could argue that with all of the fallout from the recent crypto casualties like Celsius and 3AC, by the end of July, hopefully we see where the bodies are buried, right? And we can see, and any more headlines that need to come out, like that guy's defaulted or that guy's gone bust or whatever, hopefully they come out by end of July, basically, right? So maybe there's some of that overhang is also keeping a bit of a bid to the July volatility, right? That's certainly my read on it. If you look at the price action of the actual individual maturities, rolling maturities, which are the charts on the right, again, as usual, into Friday's auction, a collapse in vol of the order of magnitude of 20 to 30 vol points in Ethereum, and yeah, about 15 vol points in Bitcoin, right? So similar to what we see. Usually Ethereum takes a bigger whack because there's a bit more flow in the DOVs coming on Ethereum, basically, right? So that's kind of what we saw in term structure. Then if we take a look at skew, so we'd already flagged last week that from a skew perspective, you know, we'd had a big repricing down of skew, which was making us more bullish. You know, some people piling into short dated calls and that risk to downside being repriced lower. So from very, very extreme levels previously. So that was good. That trend has continued. So we continue to see put skew flattening across the board. We have seen a bit of a divergence where weekly skew has flattened much harder than monthly skew. So we see 7-day put skew in Bitcoin got as tight as 5 vol points, which kind of the tights that it's seen since sort of early May before the carnage. It's back to about 7 or 8 vols now, but it's still significantly tighter than the 1 month skew. So just like the 1 month vol is holding a bid, right? The 1 month skew is also holding a bid, right? Because skew and vol kind of go hand in hand in terms of risk premium, right? If people are worried about crypto markets to the end of July, they're probably going to bid a bit more for 1 month puts as well, because the risk factor is much more of a collapse in their opinion than it is of a sharp rally. Whereas in the next week, they think the market might still have squeeze potential, and it doesn't need to collapse. And so they're bidding for that upside in the 1 week stuff, and that's flattening the skew in the 1 week, right? So that's kind of the dynamic we're seeing there. If we look at Ethereum skew, similar story, you know, the weekly skew definitely flattening more than the monthly. But if you look at that, the glaringly kind of different thing to Bitcoin is that the longer dated skew, like the 6 month, is significantly flatter than the rest of the curve, right? So you've got all the other tenors kind of hanging out there, kind of in line with each other, whereas you've got at least 5 vols less for puts in the 6 month stuff, because that's the space where there's more of a call premium, people playing the merge, things like that. And that's Ethereum centric, right? You're not going to see necessarily the same phenomenon on Bitcoin. Okay, so that's what I'm seeing in skew. If we move to flows, first looking at Bitcoin and Ethereum, you've had more call buying for sure, right? So whereas previously you've been seeing a bit more 50-50, slightly skewed to puts on Bitcoin, you had a massive call dominance this week on Bitcoin, right? So tons of calls trading, right? So what's been going on? So we've seen short dated 1st of July to mid-July expiries, 24K to 26K calls being bought in reasonable size. That's all this flow here that I highlighted in the middle. You also had some risk reversals, bullish risk reversals in the short dates as well. People willing to take a stab at selling 18K puts to buy the 23K calls in zero cost. So bullish risk reversals there, selling that expensive skew, trying to take advantage of a rally. And then all this massive call activity, bunch of stuff going on there. So some of the call buying in that sort of 1 to 2 week area, some people have been selling even higher strike calls in end of July against that. So you're basically buying 2 week calls and selling 4 week higher strike calls in a ratio, right? It's the type of trade I would do, right? Like a diagonal calendar ratio type thing. So obviously clearly some vol players getting involved there. I promise it wasn't me, okay? But basically some of that call calendar action going on, providing some of that volume in those upsides in July. But then on top of that, you're also, and the reason for selling that upside in July in more size than the stuff you're buying is to have a Vega hedge. So a bit like the conversation we had earlier about don't buy Vega by accident when you want to buy calls, right? Well, this person is not only not buying Vega by accident, they're buying the 2 week calls to get a load of delta and gamma, and then they're launching a load of 4 week calls higher up in more size to get rid of all the Vega and maybe even be net short Vega, right? So that is a trade where you will benefit from not only a rally, but a rally that where vol gets crushed. That's kind of the ideal structure for that, basically, right? So that's the dynamic that someone's playing there, the spot vol correlation, and to not get caught with a load of Vega and a load of theta decay, basically, over the next couple of weeks to try and play a rally in crypto. So I think it's quite a smart trade all in all. Another expression that's creating some of this volume on the upside is July and September call fly structures, right? So these are people trading, you know, like 2,000 or 2,000 point wide call flies in July, maybe September a little bit wider, but basically trying to have a relatively low premium outlay for a potential big payout if I go to my short strike, yeah, and not take too much theta and not take too much Vega exposure, basically, right? So it's a commonly used kind of lottery ticket style trade in a high vol environment where you want some exposure to a certain direction of the market, basically, right? So that's what they're doing there, and it's creating a ton of call volume. In Ethereum, the bigger clips that I kind of noticed were July 1,400 calls being bought in a reasonable clip there for end of July. We're still seeing puts and put spreads trading in the July to September buckets, anywhere from the 1,000 strike down to the 600 strike. So still some activity there in puts, kind of normalize a bit more 50-50 than say what we're seeing in Bitcoin. And then lastly, the DEC 22 and March 23 call spreads keep trading, right? The strikes are all shifting lower as markets have dropped a lot, but that structure is definitely a structure that is used or is being used to express that bullish view on Ethereum, basically. And we're seeing that again in those longer dated maturities. And like I was saying, that's why that skew is not as bid for puts in the longer dates, because of those type of structures that are buying upside, basically. And that's kind of the flows for Bitcoin and Ethereum. And then the last thing I wanted to highlight before we close is Solana, because Solana has obviously been listed on Deribit for a while now. And we've finally seen a pretty lumpy clip go up in Solana, right? Which I thought was worth mentioning. And that's Solana, 29th of July, 50 strike calls. And they have traded in about 40,000 lots on Solana, right? Which is equivalent to about $2 million of notional, which is a pretty decent clip on Solana, right? I would say. Okay. And it kind of blows all of the other open interest out of the water, right? In terms of what's traded in the last 7 days. You see this massive outlier, which is these July 50 calls. And you can see it here as well in the block sniffer, right? So calls dominating by 80%. Yeah, I mean, it is just the largest clip that's traded, right? What are these calls? These calls are 30 delta calls. They're trading at around 130 vol. I think when they did trade, it was a bit higher, probably like 140 odd. And basically, you know, it's not a bad way. You know, if you think Solana is showing a bit of relative strength, you're bullish crypto in the short term, you know, maybe this gives you the most bang for your buck, basically, right? Now, if you compare it to where the vol is, though, in 30 delta upside calls in something like Ethereum, you are paying a premium, right? You're paying a pretty hefty premium. Those calls are more likely to be around 90 vol, whereas this is 130 vol, okay? So you're paying about a 40 vol premium, but you look at some of the outperformance you've seen in Solana over the last week or two, it's staggering, right? So because it had sold off so much. So, you know, you pay a higher vol for a reason, right? So someone's thought by the end of July, which is a month away, you know, Solana's got some decent upside. For me, I'm still quite bearish risk assets. I don't think risk assets hold up into end of July. So I wouldn't do it. But to be fair, buying these calls and flipping out of them in a week or two, if you get a rally, maybe that's the way to play it, right? So maybe they actually do work as long as you don't hold them till expiry, basically, right? So that's kind of how I think about it, but I thought it was a flow definitely worth mentioning, okay? And that's it this week in crypto. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. To watch the entire macro call, which includes the live Q&A and a walkthrough of all my top trades, you can sign up for a free trial to Macro Insight. If you join our exclusive trading community, you'll get access to our Telegram group, and you'll also get weekly market reports summarizing the macro call. The link is in the description to the video. And for more information, you can connect with us on socials, or you can visit our website, options-insight.com. Thanks a lot.